Section 84-1411 of the Nebraska statutes, notice of this meeting was given on Thursday, January 7th, 2021. Pursuant to that same section of the Nebraska statutes, the next regular meeting of the Board of Trustees will be held Thursday, March 4th, 2021 at 4 p.m. in the Board Conference Room, second floor at the Teacher Administrative Center, 3215 Cumming Street, Omaha, Nebraska. The agenda will be kept current and available for public inspection in the retirement office at the Teacher Administrative Center during regular working hours. Pursuant to Section 84-1412 of the Nebraska statutes, the public is hereby informed that a current copy of the Nebraska Open Meetings Act is posted on the Board of Education meeting room on the north wall. With that, Cecilia, would you call the roll?
Bourne.
Here.
Havlovic is excused, and Hirschenbach is excused. Johnson?
Here.
Logan? Plasik is excused, and Ray?
Here.
4 present.
All right. Thank you, Cecilia. Calls the meeting to order. Every quarter we have a public comment section. This is the message for the public comment section of our agenda. Masks are required to be worn, covering both nose and mouth during public comment. If you do not have a mask, please let Ms. Carter know and she'll supply one for you. So far we have one speaker who has submitted the form to speak today. The board has adopted OSERS public comment policy dated March 6, 2018, which provides public comment for a period of 1 hour. That same policy limits individuals to a maximum of 5 minutes. We ask that you respect that time limit. Ms. Carter will let you know when you have 1 minute remaining and when you have 30 seconds remaining. If you're in need of an interpreter, please let Ms. Carter know and one will be provided for you. If the subject of your public comment is related to a particular staff member or trustee board member, we ask that you not mention the staff member or trustee board member by name and instead provide that information to Ms. Carter. She will assist the board and look into those details for you. If you do not get an opportunity to speak and would like to submit written commentary, please provide it to Ms. Carter. She will make sure that each member of the board gets a copy. As a reminder, we ask that you please spell your name, state your address before you begin your public comment. So it's now 4:04, and the first speaker is Robert Miller.
Good afternoon. My name is Robert Miller. That's ROBERTMILLER. I reside at 7301 North 107th Avenue in Omaha, Nebraska, 68122. Good afternoon. Thank you for allowing me the opportunity to address the OSERS trustees. OEA has been part of the Better Together Coalition since it began with the leadership of Dr. Logan, bringing all the stakeholders together. It was something that had never been done before, but was desperately needed to identify common interests to address as one collective group. During our first conversation, there was an understanding that we don't need to point fingers, be accusatory, or blame each other, but identify a path to move forward. The discussion led to the unfunded liability of OSERS and steps on how to address it. While there were a few attempts to address it, one I recall a request coming back to the trustees to make a slight adjustment, which the board did approve. The Better Together worked with Senator Coulterman on a bill, but it did not go anywhere or as fast as we'd hoped. However, the bill did bring forward a request for a study to be completed. That report of LB 31 was provided in September. This outlined whether the transfer could happen and the cost it would take. From there, it was identified that the district wanted to be out of the retirement business. Senator Coulterman and staff wrote 5 separate bills to address the transfer of OSERS to the PERB. LB 144, LB 145, 146, 147, and 582. After seeking input from various sources and the dialogue between Senator Coulterman and his team, the OEA board decided last night at the board meeting to oppose the transfer of management of OSERS to the PERB board. The major concern was not about services, but not having the representation on the transition board and ultimately losing the voice of the employees of Omaha Public Schools once the transfer was completed. Thank you.
Thank you. Are there questions for Mr. Miller? All right. Seeing none, is there any other members of the public that want to comment? Okay, seeing none, that'll conclude the public comment section of the agenda. We'll move on to agenda item number 3. Cecilia had sent out in your board packet the regular meeting minutes from January 7th of 2020. Look for a motion and a second to approve those minutes. So we have a motion.
I'll second.
So we have a motion and a second. Were there any adjustments, comments? Seeing none, Cecilia, would you call the roll, please?
Ray,
Aye.
Logan,
Aye.
Johnson,
Aye.
and Bourne.
Aye.
4 ayes.
All right, the meetings are approved. Next is a discussion on the financial statements from November and December of 2020. Cecilia, would you kind of walk through those?
Okay, for the month ending November 30, 2020, the trust fund had a valuation of $1,309,000 with cash on hand of $12,987,000. For the month ending December 31, 2020, the trust fund had a valuation of $1,396,000 with cash on hand of $13,057,000. And please, I need to remind the board and the public that the investment activity for each monthly financial statement is investment activity 1 month behind. It gets trued up at the end of the fiscal year. That ends the report, unless anyone has questions.
All right, any questions? All right, seeing none. With that, we'll move down to agenda item number 4, a discussion on the actuarial presentation in preparation for the annual valuation and the 4-year experience study. With that, Patrice Beckham of Kavanaugh McDonald is here. Welcome.
Thank you. Hello, everybody. Yeah, good. Yes, it's been a while. Yeah, I've kind of been missing in-person meetings, so I'm excited that this one is in person, even though my glasses will undoubtedly fog up. We've got a kind of a heavy year of heavy lifting on the actuarial side. A lot going on. And we thought it would be a good idea. We've got a couple of new trustees, and just a good idea to kind of refresh everybody's memory on what these different projects are, what the timing is, and lay a little bit of groundwork on some of those. So the projects that we'll have this year in 2021 will be the actuarial funding valuation that Cecilia's motion. Sorry. Come up at all? The actuarial funding valuation that's performed January 1 of each year. And then the GASB, which stands for the Governmental Accounting Standards Board, Statement 67 and 68 reporting, which is for accounting purposes. And those are both annual reports. We do those every year, and the timing is fairly consistent. And then this year, we are doing the experience study, which is performed every 4 years by statute requirement. And we'll talk a lot more about the experience study and give you a little bit of background on that. And again, we'll talk at the very end about what our timeline is, and then if you have any input or want to change that in any way, we would certainly want to hear about it. So, the funding valuation. Again, these are prepared every January 1st. Prior to 2017, we measured it on the district's fiscal year. So we used to have a September 1 valuation date, changed to January 1. It's all about funding the plan. So we're evaluating kind of the funding progress, the financial health of the system by measuring assets and liabilities. Assets are pretty straightforward. There's money in the trust. Cecilia just reported to you. We do use kind of a smoothing method to average out some of the highs and the lows. But the real question, the heavy actuarial work, is the liability calculation. And the liability represents the value today of all those future benefit payments that we expect to be paid. Two key measurements on the funding health of the system. One is the funded ratio, which is simply the assets divided by the liabilities, and the unfunded actuarial accrued liability, which is the difference between those two numbers. So it's the same numbers, but we're using them differently. The funded ratio is more relative. The unfunded actuarial accrued liability is the difference. And that essentially represents a stream of payments that needs to be made over a reasonable amount of time, in addition to the ongoing cost of the plan for members who are actively working, if we're going to fund this on an actuarially sound basis, which is required, I believe, under statute. So we have liabilities and assets. We know the difference that has to be funded. We have membership data, who tells us who's working in the current year, and that helps us determine how much needs to go in to fund their benefit, because we're allocating the cost of these retirement benefits over people's working career. So every year they work, there is a contribution that goes in to fund that benefit. And theoretically, over time, when they leave and retire, there's enough money in the fund to pay them out until the last benefit payment's made. So the board has a funding policy that, again, the funding policy addresses how that unfunded actuarial liability will be paid off, which methodology for calculating the cost for active members in the current year of service, and how the assets are going to be averaged or smoothed out. Those are all within the board's funding policy. Those three items then drive what's called the actuarial contribution rate. How much money needs to go in this year for you to hit your funding target, which is generally that you want to be fully funded in 30 years, if not sooner. And as a result of that, we compare the actuarial contribution rate to the statutory contribution rates. So your members are contributing 9.78% of pay. The district is paying 101% of that, which is 9.88%, and the state is contributing 2% of pay. So a total of 21.66% of payroll is scheduled to come in regularly with every payroll. If the actuarial contribution rate is higher than 21.66, there is an additional contribution that's due from the school district for the fiscal year that ends after within the valuation year. So the January 1, 2021 valuation would determine if there's an additional school district contribution for fiscal year end 8/31/21. And then we also prepare a valuation projection model, which is a tool that allows us to do some what-if scenarios and look forward. The actual valuation is what we call a snapshot measurement. Stop everything January 1, and that captures everything that's happened up to that date, but it's not always that doesn't provide a lot of insight into where we're headed, and that's what the models do, and they allow you to do a what-if scenario and consider some different things, especially variations in investment return. So it's an important part of the valuation work. On the GASB reports, again, there are two reports, 67 and 68. This information is used for financial reporting. It has really nothing to do with funding the plan. Totally different. This information will be used in the district's financial statements, and those two reports, one reports information on the system's funded status, that's 67, and then 68 is used by the school district, and that has information more specific to their financial reporting. That measurement date is August 31 because that's the school district's fiscal year end. We are able to what we call roll forward the liabilities from January 1 to August 31 using standard actuarial formulas that assume that all assumptions occur during those 8 months. So that gives us the liability side of those calculations, and then we get the actual market value of assets as of 8/31, and that's used in the district's GASB reports. So again, it's for a different purpose. It's the actuaries are doing the calculations, but the accountants and auditors are the ones who have developed the methodology behind that. And I won't question them because they know way more about accounting than I do. All right. The big study this year that might be new to a lot of you is the experience study. Again, there is a statutory requirement for Nebraska that an experience study be performed every 4 years. For us, the study period, which is when we look at what actually happened to the membership, that'll be calendar years 2017 through 2020. So to capture changes, retirements, terminations, deaths, during 2020, we have to have the data at January 1, 2021. So we know the status at the beginning of the year and status at the end of the year. So we'll be doing the valuation first so we have that demographic information, and then we will use it in the experience study. It is a statutory requirement, but we were doing these long before it was in statute. Statute just fixed the study period at 4 years. I think we used to do them every 5. So this is just a chance to step back and do a deep dive into all the methods and assumptions that we're using in the valuation to be sure that we still believe those are our best estimates, that the methods are accomplishing what the board wants them to. And the assumptions are split into 2 groups: economic assumptions, which have to do with what's happening with the economy and generally money, and demographic has to do with what's happening with your people, with the members. Again, are they terminating? When are they retiring? How long are they living? So when we talk about assumptions, and we use a lot of assumptions in our work, it's important to realize that that is all they are. I have heard comments that the actuary would just change the investment return assumption, everything would be fine. Well, it really wouldn't, because you're going to earn what you're going to earn. And just because the actuary changes the assumption higher or lower, it doesn't mean that that's what you're going to earn. So we're using these assumptions because we have data on the valuation date. We know that. But the benefit that will ultimately be paid is dependent on what happens in the future. And we don't know that. So that's what those assumptions are helping us consider is, what's the probability that people are going to retire, and when, and how long will they live, and all those things drive the liabilities because they're benefit payments. The valuation process is really an attempt to fund the cost of the benefits systematically over time. And the method that we're using develops a cost that's level as a percent of payroll over a member's career. How we fund those benefits and when money goes in affects the timing of the cost, but ultimately the cost of the system or the benefits that are paid, right? And we don't know that until you sort of get to the end of the road, but what we're trying to do is look forward at all those future benefit payments and create a contribution stream that can be relatively stable and, again, paid while active members are working, that will accumulate with investment income and be sufficient to pay that benefit out. When we have differences, the actual experience differs from what is assumed, which really happens every year. It's just a matter of the magnitude. That impacts the costs. If we're assuming 7.5% investment return and we have a 13% return, that's favorable experience. We didn't expect it to be that high. That will improve the funding and drive the actuarial contribution rate down, and of course, vice versa. The goal is to try to create stability in those contribution rates, because to budget for these obligations and the volatility associated with them, we're trying to do everything we can with that actuarial funding policy to provide more stability and give the school district in particular a chance to anticipate what might be coming down the road. Again, we don't want to be too aggressive or too conservative in setting these assumptions, or you end up shifting costs to earlier years or later years, and that impacts members and taxpayers both. So as a math person, I love it when there's a right answer, but there is not a right answer on assumptions. There is, but I won't be here 30 years from now to report on whether we were right or not. We have to recognize that there's a lot of art as well as science to the process. There's a lot of subjective professional judgment that comes into this, and that for every assumption we look at, there's a reasonable range that, you know, qualified actuaries could look at that and have different opinions. And they do. It's not uncommon. We generally try to pick what we feel is the best estimate, which tends to be around the middle of the range. But there are sometimes reasons to be a little bit off that. Again, ultimately, that's our recommendation, but it's up to the board to actually decide. Assumptions are long-term estimates. These benefit payments go out 80-plus years, and that's just for the current members. If we take new members into account, they go on even further. And we're measuring them every 4 years. So there's a challenge right there. And so we know there are going to be fluctuations. We know there are going to be times when salary increases are lower than what we expect and times when they're higher. And so that's where it can create sort of a challenge in this short-term measurement of a long-term estimate. And so we frequently consider what happened in the prior study as well, so at least we've got 8 years of data, and that gives us more data, which increases the credibility and time for kind of economic cycles to be fully reflected. So the experience study is a big project. The data in it helps us analyze how well the current assumptions are anticipating actual experience. And if they're not doing a good job, we take a closer look, and often we will recommend some kind of a modification. Doesn't tend to be extremely dramatic. We tend to look at the difference, and if we assign it enough credibility, in other words, we believe that it is actually a change or a trend, we tend to move in that direction, remeasure next time we do an experience study, and if we see the same trend, we move further. And so we do it sort of incrementally, because if we come to the next experience, if we moved all the way there, and then the next experience study, it flipped the other way, we'd be changing assumptions and costs would be bouncing around. Again, our job is to perform the analysis and present you with our recommendations, and of course explain how we arrived at those. You really have the hard job because you're fiduciaries. And so you are actually responsible for selecting the assumptions. And you can adopt all of them, none of them, some of them. It doesn't happen very often that the actuary's recommendation is not adopted, but it has happened to me a few times. So that, again, that's the board's right, and we don't take that personally because you're the fiduciaries. So a lot of the demographic assumptions, we look at the actual experience. Again, when it comes down to how many people age 55 who are eligible to retire under Rule of 85 retire, we're crunching those numbers. How many actually did retire? How many under the assumption would we have anticipated would retire? And that helps us analyze that experience. Now, that kind of experience is very helpful on something like mortality, okay? That's not a voluntary thing, like retirement or termination. It's not particularly helpful on economic assumptions, in particular the investment return assumption. We can look back what happened in the last 4 years, and you can almost guarantee that is not going to happen in the next 4, let alone the next 30. So we always have to keep that in mind. And the demographic tend to be more reliable to use as an indicator for the future than the economic assumptions. And again, there's both kind of objective and subjective parts of this process. If you gave this data to 10 actuaries and they all did the number crunching, and they should come up with the same number of actual occurrences and expected occurrences. That is not subjective. That's very objective. But when you look at that data, interpret it, and decide on whether there needs to be a change and what it should be, that definitely involves professional judgment, and it's just subjective. Again, there's no right answer. So this is a slide. This is not specifically your assumptions. This is just kind of a generic slide to help you understand the types of assumptions. So just a couple on the economic assumptions. Price inflation, even though you don't have a COLA that's related to inflation, price inflation, as you'll see in a minute, touches almost every other economic assumption. So we analyze it separately, and then we use it to develop the other assumptions. Investment returns, the single most important assumption we use. What appear to be little changes in that assumption have very, very large impacts on the funding. And then wage inflation is, think about that as the across-the-board increases. Tends to be more than just price inflation. And then individual salary increases are composed of wage inflation and what we call a merit scale, which is as people work longer, get more hours towards higher degrees, they move across the salary grid, and that's the merit component. Demographic, everybody knows mortality. How long will people live? The system is paying benefits for life, so if people live longer, more benefit payments, higher liability, higher cost. That's why that one's probably the most powerful demographic assumption. And then it's important when people will retire, because again, that impacts the duration of the benefit payments and how long you have to fund the benefit. That's another important one. Disability termination, those are events that happen that change the benefit the person ultimately receives from OSERS. And then you can see on the right-hand side, generally kind of who selects them. There's a lot more input on the economic assumption side, which is pretty normal. On the demographic side, I've never found anybody who really wants to argue with the actuary about mortality, but there's probably a first time for everything. Just so you know, we don't just, get together and say, well, what do you think we should use for the investment return assumption for OSERS? We follow actuarial standards of practice. Those are issued by the Actuarial Standards Board, and credentialed actuaries, such as myself, have to follow those ASOPs, as we call them, the professional guidance. And it is all about not what the answer is, but about the process, what we should consider and how we should go about it. So there are two that are specifically impact the experience study. There's one on the selection of economic assumptions, that's ASOP 27, and then another about the selection of demographic assumptions for pension funding, and that's ASOP 35. And this really forms the basis of all the work we do and the professional standards that apply to it. So we use what's called the building block methodology for economic assumptions. And this is just kind of a little visual. The ASOP 27 is very specific that the inflation component in all of the economic assumptions has to be consistent. So you can't choose a high one, investment return, and a low one on salary increases. My partner says this is the no cherry picking rule. So we always make sure that the inflation assumption is the same. That's why we study it individually. You can see for investment return, it's composed of price inflation and then a real rate of return that's impacted by the asset allocation and then the expected return for each of those asset classes that you're invested in. And then again, the general wage increase, again, across the board, there tends to be a productivity component to how wages increase over time. If you looked over long periods of time in the U.S. economy, wages almost always increase faster than inflation over longer periods. And then again, the merit scale, we talked about that earlier. So just a refresher, because it's been a little bit since we've talked about the valuation. The current economic assumptions that we will be using in the 1/1/2021 valuation is price inflation of 2.75, a real return of 4.75, so the investment return assumption is 7.5%. Then again, the real wage increase of 0.5% above price inflation gives us 3.25. And then the payroll growth is sort of a quirky one. That doesn't affect the calculation of the unfunded actuarial liability or the funded ratio. That comes into account when we calculate the payment on the unfunded liability, because that payment is calculated and intended to be level as a percent of payroll, right, over 30 years. So I have to make some kind of assumption how payroll will increase if I'm going to create a dollar payment stream that's going to increase. So that one is always a little quirky to remember how that one works. The cost impact of different changes to the assumptions, again, this is each one in isolation. Sometimes you get an interaction between the two. But if people live longer, it's going to increase liabilities and costs. I think that one's always kind of an easy one to understand. If people retire later, even if they get a bigger benefit, it's paid for a shorter period of time, and you have a longer period to fund it. Again, we're funding it while they're working. So that actually will decrease the cost. Disability, if there are fewer disabilities, that tends to decrease liabilities and costs. And termination, if more people terminate, we don't have to pay those folks a retirement benefit. The one at the end of their career, we still have to pay them something, but it tends to be lower than the full retirement benefit if they continue to work. So that'll decrease costs. And then, as you may or may not be aware, when people are vested and they terminate, they can take a refund of their employee contributions with interest. But if they do, they forfeit the employer, they forfeit the monthly benefit. I shouldn't say the employer, but they forfeit a monthly benefit. And sometimes people take a refund, and the refund is lower than the value of the benefit. Because it's hard to figure out, what $500 a month is worth 15 years down the road. So if there's more of that, it will tend to decrease the costs. So this is just kind of when we look at assumptions, what approach do we generally use? So for mortality, it's very clear. It varies by age and gender. Females tend to live longer than males, and it definitely increases with age. Retirement, that tends to vary by the type of retirement. There are lower rates for early retirement because people take a reduced benefit, and that isn't attractive to most people. Once they get to what we call normal retirement, which means there's no reduction, tends to be higher. And then you also get combinations like age and service when you have Rule of 85. When people hit that magic, they first hit it, it generally is a spike, a higher probability of retirement. Disability varies with age. That one, again, is pretty straightforward. Termination, we generally look at an assumption that's correlated with years of service. As people work longer, there is a lower probability that they'll leave. Because normally, if you're not happy, you'll leave sooner, not later. And then the refund, it's usually correlated with age or years of service. Again, the more years of service you have, the higher your benefit, kind of the more, and the closer you are to retirement, it's more obvious what the value of that benefit is. All right, now we get to talk about the really fun stuff. So I've been an actuary for a really long time, over 35 years. And for the first time in 2019, the Society of Actuaries released a table, mortality table, that was based solely on public plan data. I mean, this was the talk of cocktail hour with pension actuaries for a long time. But seriously, we're pretty excited about it. It's never happened. We've always felt like there was a difference, but you can't prove it if you don't have the data to do that. There are actually different tables for different types of jobs: public safety, teachers, kind of general civilian employees. And the hope is and thought is, and it's kind of working out this way, it's only been around a little bit over a year, but there tends to be less need to adjust the basic table to try to fit the group you're looking at with these many, many tables. We will undoubtedly consider this table and some variant of it. Again, they've got all the different teachers, public safety, general. They've got above median, median, below median. There's a lot of different tables there. But what we're ultimately looking for is a mortality table that is what we call a good fit to what we observe in your membership. It's not a one-size-fits-all. And your mortality may look different than what the state retirement system uses. You know, you're an urban school district. They have a lot of people in outstate Nebraska. Could look different. And again, another adjustment that we sometimes make to get the table to fit better is what we call an age adjustment. So an age setback would treat a 65-year-old as if they exhibit the mortality of a 64-year-old. So it's better mortality than what the tables anticipate. And a set forward is just the opposite. If it's a one-year set forward, that 65-year-old female exhibits the mortality of a 66-year-old in that table. So it's just a way to sort of shift the curve, the mortality rates to get a better fit. And we'll go through all that and share the results and explain to you where we end up on that recommendation. So, last slide, talk about timeline. Again, we really have to have the January 1, 21 valuation completed before we can start the experience study. Jim is usually kind enough to give us the census data in February. It's a lot of work that goes into reconciling everybody who was there in 1/1/20 to who's there 1/1/21, some back and forth. We get that nailed down. That gives us liabilities. We get asset information in April usually. And then I think the goal is to be back with you in May and present the valuation results at that time. So it was a generally good calendar year for returns, so hopefully I have good news to share with you. And then as soon as we get done with that, we'll just jump right in and start the experience study analysis in June. Hope to be done and ready to talk to you in September. We are finding that it's taking kind of a couple of meetings to get people through that process, and we've been kind of breaking it up and talking about economic assumptions in one meeting and demographic assumptions in a separate meeting to not overwhelm you, because there's only so much actuarial stuff anybody can listen to. So we'll kind of play that by ear if that's okay with you, and if you need to take longer, that's fine. Truth be told, we won't use these assumptions. We'll use them for the January 1, 2022 valuation, which we won't even start working on until about March of 22. So there's plenty of time. There's no rush. That's the advantage of sort of jumping on it and getting it done sooner. Gives you plenty of time to noodle on anything and come up with your, a set of assumptions that you feel comfortable with. But I kind of laid out some possibilities there. And then the GASB report's always done in October, again, because the fiscal year end is 8/31, and the school district needs that information in a timely manner. So I rolled on pretty quick there, but any questions? Or there's a lot of education in the experience study, so I touched a lot of stuff. We'll take our time, delve into it, again, slow it down in 2 or 3 meetings, give you time to digest it all.
What a great explanation. I'm new to the board, so I just have a couple process questions, and maybe Cecilia, this is for you. So it seems to me that while ultimately the decision on the discount rate and those things are OSERS board, how is this information communicated to the district? Is that just Dr. Logan being a part of this, or is there interaction between us and the OPS board relative to this timeline and the information that?
That's a good question, and I'm not sure I'm the one to answer it.
I think we got the expert, right?
Well, every year after the valuation report is completed, the superintendent is generally in the meeting, but I do make it a practice to formally file our valuation report with the president of the school board. So it is sent over via email, and I'll hand deliver a hard copy. Our new CFO, the district CFO, has been sitting in on our meetings, so they, and he can get a copy of it as well. So he'll be in the meetings. And then when it comes down to the experience study, this will be my second experience study. We, may have conversations with the district. If we are not in COVID, we're sitting around a table discussing this. But ultimately, the decision does fall on the Board of Trustees.
Okay, thanks for that. Are there any questions for Patrice?
Okay.
All right,
Thank you.
Great explanation. Appreciate it.
Yep.
Excellent. Okay, thank you. We'll move down to the agenda, to agenda item number 6. And there's a couple things that we're going to have a discussion about here. Cecilia has a handout that's kind of talking, or it kind of goes over what's currently being required in Legislative Bill 145, which is part of the package, I guess, of bills that have been introduced into the legislature. And so we're going to have Cecilia kind of walk through that. And again, this agenda item and the next one, we're trying to be as proactive as possible given the legislation that's been introduced. And so look forward to this discussion.
Okay, given that LB 145 is calling for a compliance audit, I took a look at what is currently in the OSERS statutes. And it does not mention compliance audit, but does say that the board has the Board of Trustees, at the option of the Board of Trustees, an audit of the affairs of the retirement system shall be conducted by a certified public accountant or the auditor of public accounts. Okay. We have historically had Sime Johnson, a certified public accountant, conduct our audit of financial statements and looks at operations. I also gave you an outline on the back to try to explain the difference, because at our last meeting, Mr. Hirschenbach asked, well, what's the difference between an audit by the Auditor of Public Accounts and a compliance audit? So in reviewing what the Auditor of Public Accounts has on their documents in previous audits that I've seen them do, they are basically focusing on the administrative operation issues, also including the financial statements. In comparison, the compliance audit does a more in-depth review of governing laws, plan documents, administrative policy and procedures for the pension plan to determine whether things are being, whether the plan is being administered in compliance with applicable provisions of federal and state law. And I gave you a little list of some of the things that the compliance audit, which was done for the state, what they looked at. So I do think, we've never had a compliance audit. Let's look at it. And the audit by the Auditor of Public Accounts, that's a different question, whether Sime Johnson does the sufficient look-through. And I have asked Sime Johnson to put together for me an explanation of their work papers. Now, I don't want them to turn over their work papers, but to put together an explanation of their work papers and exactly what they look at behind the veil other than just the financials.
So basically, we do the financial audit on a regular basis, but it's come to our attention that we haven't done a compliance audit in a period of time. And so what I was going to ask Cecilia to do is to prepare an RFP for a compliance audit that she would present then at the March board meeting for us to make a decision on whether we go forward with the audit, the compliance audit. So we're not going to take a motion or anything, but that's kind of what we're thinking is, again, it seems to me to be best practice that we would do some sort of a compliance audit. And I think the state does one every 5 years on their plans. And again, we haven't done one in at least that time period, so it seems to me that it's time to do that. So we'll have that as an agenda item in the March board meeting with the RFP that Cecilia will go through, and she'll have some additional information about the difference between the auditor of public accounts and what Simon Johnson does and that. So we'll be able to make an informed decision. Roger?
I did have a couple of questions about the compliance audit. One of the reasons the state does one on a regular basis is that it's required by statute. Ours is not required by statute. And I'm not sure what we gain from a compliance audit other than a comfort knowing that we're operating within the rules of the retirement laws. However, all of our benefits are guaranteed or are stipulated in state law. And I find it difficult to believe that something would happen in our benefit structure that would be different from what the federal laws will allow for retirement benefits. So I understand what, to put it somewhat candidly, the compliance audit was required at the state level some years ago because there was friction between the retirement system and the state legislature. And the compliance audit was done as a kind of a penalty to assure that the state senate, the retirement system knew who was in charge. I hope that's not the case here, that this is being done as a penalty. If there's information we can gain from this that would be useful for us, I think that would be useful. But in the 5 years that I served on the PER board, they did a compliance audit a couple of times, and we never learned anything new for the compliance audit. And I thought it was kind of a exercise in futility. I hope that's not the case here, but that's my general reaction to the compliance audit.
Fair enough. Other questions or comments? Okay. So again, that's kind of how we're going to proceed. Unless there's strong objections, we're going to have Cecilia prepare the RFP, and then we'll have that discussion at the March board meeting. The other item I wanted to discuss in agenda item number 6 is, as part of the LB 31 and some of the Better Together Coalition, we've in discussions with Senator Coulterman, it seems as if our compliance procedure manuals haven't been updated in some period of time. And so it seems to me that if we do go forward with a compliance audit, that would be one of the findings, that our compliance manuals or procedure manuals are somewhat dated. And so it seems to me to be proactive. We should ask Cecilia, as just a normal course of her administrative duties, to begin updating those procedure manuals. Again, because we're pretty confident that it hasn't been done in a number of years, and so if we do indeed do the compliance audit, the procedure manuals would have to be updated at that time anyway. So again, trying to be proactive and good plan management. It seems to me that having Cecilia bring those up to date, whether it's using some of our legal resources or what have you, but it just seems to be a good practice to update those. Questions or comments relative to that? Okay. Moving down to discussion or agenda item number 7. Again, the document that Cecilia handed out does talk about either a certified public accountant doing the compliance audit or the auditor of public accounts. And so Cecilia is gathering some additional information about what the difference is between the two, and getting some additional information from Simon Johnson and what their audit uncovers relative as compared to, say, the auditor of public accounts. So just wanted you to know that activity is being done. Agenda item number 8, discussion of the fiscal year 2022 budget for OSERS. Cecilia?
Okay, in your package, this is just the first reading. In your package is a 2-page document. The front of it says OSERS fiscal year 2020 budget proposal first reading. What I've outlined are column B, Fiscal year 2020 actual expenses. These are the numbers that we closed off 2020 with. Item C gives you 2021 fiscal year current budget. So this is what was adopted into our budget system. Okay. Column D gives you our numbers, where we are at from September, because remember our fiscal year is September 1 through August 31, so September through December. And here is where we are at on each line item. Column E gives you what I forecast will be the expenditure by the end of August. And so column F gives you the proposal for the 2022 budget, fiscal year ending 2022. Salary, I think I just took that up. That does depend on negotiations. Salary, I think I just took that up by 2.5%. We'll see what negotiations reveals. And our benefits are just a given. They go along with whatever salary increases are. Okay. But now when we come down to purchase services, I did have to put an increase into audit if we are to start having compliance audits and additional audits. So that line item has increased. Legal services, I actually think that's going to start coming down given, unless we have some major litigation matters, those will start coming down. Contracted professional services, those same services are still around, so that will remain about the same. Actuarial services, that should remain about the same. I have the projected cost of valuation reports and experience studies from their contract proposal. We are about spot on each year for portfolio management fees. We closed out fiscal year 2020 with a little over $1.7 million in portfolio management fees. So I'm going to let that remain at $2 million. It might be a good thing if it goes up. That means market values went up. Allowable indirect costs. Given the look-through that we went through last year and knowing how it's now being calculated, it should be around $50,000. And then the other minor things, supplies, in-house printing, those were, we budget $2,500. We spent about $250. Then getting down to other expenditures, dues and fees, professional dues and fees, those are about the same. Liability insurance, the last 2 years we were not charged. However, I know I'm working on the liability insurance questionnaire next week. So, attendance to workshops, continuing education. Given COVID, we're going to be doing more things online even for the next coming year. Okay, so there will be some cost savings there, and I should be able to bring the budget number down. And then other expenditures, that line item, remember those are transaction costs associated with managing the portfolio at the NIC. Okay, so those are bank fees, security lending fees, just trying to think of some of the trading costs. If you look up, I should have mentioned this before, back under purchase services, the line item titled bank service charge, we used to carry it as $120,000. That was the cost when we were doing our investments in-house, okay? Unfortunately, the way the accounting reports come in and the reports that we get from the Nebraska Investment Council, it's too difficult to break it out, and that bank cost covers the custodian, the transaction fees. So that is what is represented down now in other expenditures. So I'm taking that line item to 0. Again, this is the first reading. Please go through it. If you have questions, do not hesitate to call me. On the back of the page, I wanted to just give you a picture of what 2020 looked like compared to where we're going in 2022. So in 2020, our pension trust fund closed out with a valuation of $1.378 billion. Okay? I'm showing you that staff salaries and benefits represented 18% of the total expenditures for the year. Our discretionary spending represented 14.9% for the year, and our big expense for the year goes to 66.3%, which is attributable to investment costs. Again, looking at the big picture, staff benefits as a percentage of the total portfolio value, 4 basis points. Discretionary spending as a percentage of the total portfolio value, 3 basis points. Investment cost as a percentage of the total portfolio value, 12 basis points. Total expenses to the portfolio value, less than 20 basis points. Then if we come down to 2022, I'm trying to show you the same thing, that with the projections, the overall expense of salary and benefits should be about 16.3% of total expenses, discretionary 19.5% of total expenses, and investment costs roughly 64.3% of total expenses. With that, that is the first reading. That's the proposal. Again, if you have any questions, please don't hesitate to call me during the month, and we'll bring this back again next month for adoption.
Roger?
I do have a question about the audit. Looks like the compliance audit is going to be about 10 times more expensive than a regular audit. Is that what I'm seeing on the proposed budget?
Yes, I do know that the audit for NPERS, which does cover 4 plans, okay, is the last one they did was $275,000. So I'm taking a projection. I'm not taking $275,000, but it's going to be somewhere $50,000-$75,000.
And I would reiterate my concern about the expense of a compliance audit and what we get for that kind of money. That's a lot of money to do something that may or may not be beneficial.
Yeah, I understand, Roger. I will say that NPERS uses a firm from D.C., and in my personal life, I guess, not personal, but my business life, I've had experience with that firm, and they tend to be a kind of a premier law firm. So, I think that hopefully we can find somebody local to do that. So, then I think then there'll be an opportunity to really, once we get a complete understanding of the costs, we'll be able to, make an assessment of whether or not we should go forward. So Cecilia, could you walk us through the process? So it says the first reading, and could you kind of, for the new board members, kind of walk through, with second reading and when this budget becomes final?
Okay. So again, this is the first reading. Let the board look at, absorb, ask any questions. The second reading will come back in March, and if there are any questions, we will have talked it through already, and then I'll present the second reading in March. And if the board adopts the budget at that point, that gives me the freedom to go ahead and submit our budget into the OPS budget system so that this can be used to monitor.
And as far as the timelines, we'll have some information about what the cost of a potential compliance audit would be?
No, not necessarily. So if that's a very good question. We may have to do a budget amendment if we found out that, oh my gosh, this is going to cost way more than we thought it was going to cost. Or we just go over budget and it just shows on our budget report, okay? And that's fine, long as everybody has an understanding, this is why.
Okay. Any questions about the first reading or the process for the approval of the budget? All right. We'll move down to the Executive Director's report. Cecilia?
Okay, so I'd like to remind the board and the listening public that nominations for the trustee elections for 2021 open tomorrow, Friday, February 5th at 9 a.m., and the nomination period will close on Friday, February 12, 2021 at 4 p.m. Nominations can be taken only in person. We will not accept email nominations. Those wishing to nominate themselves or have another person nominate them may do so by coming to the TAC building. They will probably have to call the retirement office from the lobby, and we will come down and meet them. The retirement office phone number is 531-299-0329. Nomination statements and headshots will be due to OSERS by March 5, 2021. Again, this is for the certificated trustee seat, active members only. And a reminder, if only one candidate is nominated, OSERS will not hold an election. Next, I want to inform the board and listening public that the IRS Form 1099-Rs and the 1099 miscellaneouses for tax year 2020 were sent to recipients on January 30, 2021. It was reported that there were 5,724 1099-Rs and 3 1099 miscellaneouses. OPS will file the necessary reports with the IRS by February 28th. We're in the middle of legislative session, and the new speaker, Speaker Hilgers, has set parameters for legislative hearings. There are basically 4 options to give testimony at a hearing. First being in person with you in the room, like normal testimony. The second is a written testimony in lieu of in person for inclusion in the transcripts. However, your typed testimony must be handed into the clerk between 8:30 and 9:30 a.m. the morning of the hearing, and it must be handed in person. Okay? There's also an opportunity to give written position statements. These will be shared with the committee, but not included in the transcript. And then there's also an online web portal that allows citizens to give comments. These will not be included in the transcripts, but are said to be shared with the senators. Next, I'd like to also let the board know that we have been looking at some ways of cost savings and ways to alleviate some of the work that is being done by other departments to support OSERS, and effective either April or May, I do want to work with OPS first, either effective April or May, OSERS is going to stop sending the monthly pay stubs to retirees, and these are only the retirees who have retired January 1, 2015 or prior, because anyone after that is able to access their pay stub online. We will give notice to these individuals. They will still get a year-end statement, their 1099-R. I've had a discussion with one or two retirees, and there's also, when there's a change to the member's monthly benefit amount, i.e. the medical COLA, we will send out a little notice that says, this is why your monthly benefit changed. But I think that will help alleviate some of the work that is required to support OSERS administration. Lastly, staff is working in person, so we're all back in the office wearing masks. And that ends the executive director's report. If there are any questions.
Questions for Cecilia? Roger?
I do have a question, or at least a comment. I'm glad to see that the old retirees will get the paper copy of the 1099s as well as paper copies of changes in the amount of money that they received based on COLAs that might be received. There's one other thing I think we need to keep in mind. Tax rates change from time to time. Withholding rates change from time to time. If the member did not request a change in withholding, sometimes this stuff just happens. I want to make sure that the members are notified before any change in their take-home, because if they're depending upon a certain amount coming in their checking account, they need to know in advance that that's not going to be there, or it may be higher. So not only COLAs, but also any with changes in withholding.
Well said, Roger. And the intent isn't to, impact the members in any way. It's just to kind of look at processes and things that we do that might be of minimal value that costs a lot of effort on our behalf to administer the plan. So anyway, thank you. Thanks, Cecilia. Next, we'll move down to the trustees report section. If there's any trustees that have any updates. Roger?
I do. There's one of the things that I think we need to take note of. NSEA has been neutral on all the bills affecting OSERS prior to the decision by OEA to oppose certain bills. And as NSEA informed me today that they will be opposing LB 144, 145, 147, and 582. They'll be in support of 146. 146 is the one that changes makes it clear what the definition of a substitute teacher is for the first 180 days. They think that's a good rule. That happens to be the rule for OSERS now, so it's nothing that involves OSERS. It would impact the other retirement systems. But I just need to make on the record that NSA will be opposing the other bills that would transfer the management and governance of OSERS into the state system.
Thank you, Roger. Any other updates from? No, seeing none. Thank you. Okay, with that, we'll move down to the agenda item 11, action on legal matters, and this one is a closed session. Roger, do you have a motion?
Yes, I move that the Board of Trustees go into closed session for the protection of the public interest and for the prevention of needless injury to the reputation of individuals, to discuss with legal counsel and Cecilia Carter litigation matters affecting the trust fund and personal financial matters regarding members of OSERS.
All right, we have a motion. Do we have a second? We have a motion and a second. Cecilia, would you call the roll, please?
Ray?
Aye.
Logan? Johnson?
Aye.
Bourne?
Aye.
4 ayes.
Okay, with that, I've a statement to read. Let me remind the board that the purpose for closed session is for the protection of the public interest and for the prevention of needless injury to the reputation of individuals, to discuss with legal counsel and Cecilia Carter litigation matters affecting the trust fund and personal financial matters regarding members of OSERS. So with that, we are in closed session. All right, Cecilia, would you call the roll, please?
Bourne,
Here.
Johnson,
Here.
Logan, Ray.
Here.
4 present.
Okay, with that, we've heard the information from our executive director on payroll, retirements, deaths, refunds, and accounts payable in the closed session. So I'd look for a motion.
She's got it. Go ahead.
I
Judy.
do. I'm so sorry. I move that the Board of Trustees for the month of February ratify pension payments in the amount of $11,225,767.49 to 5,094 payees. Approve staff payroll in the amount of $32,303.18. Approve 4 new retirements effective February 1st, 2021. First person check paid March 3rd, 2021. Ratify the termination of 13 retirements due to the death of the retiree. Approve refunds of $354,197.82 to 26 former employees and members of OSERS, and approve accounts payable in the amount of $16,848.67.
All right, is there a second? Dr. Logan, we have a motion and a second. Any discussion? Seeing none, Cecilia, could you call the roll, please?
Ray,
Aye.
Logan, Johnson,
Aye.
Bourne.
Aye.
4 ayes.
And is adopted. Thank you, Doctor. Any new business? Seeing none, I move to adjourn at 5:18.
We are done.